Guys, so in this particular episode what we will be covering is Carsoon. Okay, so what does Carsoon do is it's a public limited company and it constructs premises for third parties. It has a year end of 20th February 20x7. On 1st March 20x6, Carsoon invested in a debt instrument with a fair value of 6 million. On February, right? On March, exactly 1 year ago, and then has assessed the financial statement is aligned with the fair value through other comprehensive income. Okay, the interest has the instrument has an interest rate of 4% over a period of 6 years. Okay, over a period of 6 years, right? And then the effective interest rate is also 4%. Okay, so no change. On March 20x6, the debt instrument is not impaired in any way. Okay, on March. During the year to 20th February 2007, there was a change in interest rates and the fair value of the instrument seems to be affected. Okay, the instrument was quoted in an active market at 5.3 million, but the price based upon an in-house model showed that the fair value of the instrument was 5.5 million. This valuation was used upon the average change in value of range of instruments across number of jurisdictions. Okay. And then the directors of Carson felt that the instrument should be valued at 5.5 million and that this should be shown as level 1 measurement under IFRS 3 fair value measurement. This is not a significant increase in credit risk since 1st March 20x6. There has not been a significant increase. Okay, expected credit loss to be measured at the amount equal to 12-month credit loss of 400,000. Carson sold the debt instrument on 1st March 20x7. Okay, so for 5.3 million, the directors of Carson wish to know how to account for the debt instrument until its sale, right? Okay, so let's talk about it. Financial asset. So IFRS 13, right? Let's talk about this thing first. Financial instruments. States that debt instruments measured at fair value through comprehensive income should be measured at fair value in SOFP. The interest rate is calculated based upon market rate. I mean the interest income is calculated. Alright, and then fair value gains or losses on these assets are recognized OCI and then expected credit loss. Where is it? Is it about expected credit loss? Yes, expected credit loss of 400,000, right? Expected credit loss do not reduce the carrying amount of the financial asset which remains at fair value. Instead, an amount equal to expected credit loss allowance is recognized in OCI. Okay, that's what it is. What is done. So since it is not measured at amortized cost, right? Since the business model test is to sell it as well, not only collect the contractual cash flow. That's why it's from other comprehensive income, right? So only it is recognized in OCI. Okay, when these financial assets are derecognized, recognized the cumulative gains or losses recognized in OCI will be reclassified to PL. Okay. The fair value of the debt instrument needs to be restated at 28 February. What is the ending period? 20x7. 20x7 IFRS 13 fair value measurement states that level 1 inputs are unadjusted quoted price in an active market for identical or similar assets at the measurement date. Okay. It is only adjusted under certain circumstance and when it is available and in this case this is available, so it can only be used, so we ignore the in-house model. Okay, therefore the accounting for the instrument should be as follows. which is basically the bond. The debt will be valued at 6 million, will be initially valued at $6 million. INTEREST interest of $0.24 million will be received and credited to SOPL. At 28th February 20x7, the debt will be valued at, how much was it revalued to? 5.3 million, right? 5.3 million, and a corresponding loss of, how much did they lose? Dollar so 6, right? So 6.24 minus 5.3. No, it's 6 and then minus that. So 0.7. So corresponding loss of 0.7 million will be charged as an impairment loss of $0.4 million and $0.3 million impairment loss of this will be charged to PL, and 0.3 million charged to OCI. Isn't that the expected loss? No, it's credit loss of this, right? 400 million. Zero x7. Of loss, right? Out of this loss, it's basically we are allocating this for impairment because of the credit loss, and then 0.3 million was the actual loss in value. Okay, so once this is done, next one is done. So let's look at question number 2. Carson constructs retail vehicle outlets and enters into contract with customer to construct buildings on their land. The contracts have standard terms which include penalties payable by Carson if the contract is delayed. In the year ended 20th February 2007, Carson incurred general and administrative cost of 10 million and costs relating to wasted materials of 5 million. They have been recognized as contract assets. Why was this wasted materials recognized as contract asset? Due to poor weather, one of the projects was delayed. As a result, Carson faced contractual penalties. Carson felt that the penalty should be shown as contingent liability. Okay. Additionally, during the year, Carson agreed to construct a storage facility on the same customer's land for 7 million at a cost of 5 million. This was completed during the financial year. The directors of Carson wished to know how to account for the 15 million cost, the penalties, and the storage facility in accordance with IFRS 15. Okay. Okay. So IFRS 15, right? Revenue recognition. IFRS 15, revenue from contracts with customer specifies how to account for costs incurred in fulfilling a contract which are not in the scope of another standard. These are divided into those which give rise to an asset and those which are expensed as incurred. Entities will recognize an asset when costs incurred to fulfill a contract meet certain criteria, one of which is the right or one of which is that the costs will be recovered for costs to meet the expected to be recovered criterion. They must have contractual right. They need to be either explicitly reimbursable under the contract or reflected through pricing of the contract and recoverable through margin, right? General and administrative costs cannot be capitalized unless these costs are specifically chargeable to the customer under the contract. Similarly, wasted material costs are expensed, right? Expensed as incurred therefore total expense of $15 million will be charged to SOPL and no asset is recognized, right? Anything else? So about the storage facility, right? Penalty. A penalty is a form of variable consideration, just like reward, right? The penalty payable should be estimated, first of all, should be estimated and deducted from transaction price. Transaction price, if it is highly probable that a significant reversal in the amount of revenue recognized will not occur when the uncertainty is resolved. The construction of a separate storage facility is a distinct performance obligation. Contract modification for the additional storage facility would be in effect a new contract which does not affect the accounting for the existing contract. When the contract is modified for the construction of the storage facility, an additional $7 million is added to the consideration which Carsoon will receive. The performance obligation has been fulfilled, so all amount will be recognized as revenue. Okay. So this is basically how we answer this question. So next is regarding management commentary. So I will discuss that in next video so that it won't be too long. Okay. So I'll see you in the new video, in the next video, I mean. And then if you have any comments until now, please do comment down below. I'll definitely be looking forward for your comments. Until next video.